Yo, 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 what is up, guys? Welcome back to another Thompsons Two Cents. It's been a week, it's been a month for October. Happy Halloween. Had an outfit on this morning on the morning show. Check that out. I was Farmer Fran, but put back on the business clothes because I mean all business today. So today we're going to get into it. The theme will be around it's only tech stocks. But it's only tech stocks to me that are extended. You're hearing this bubble talk, you're hearing this melt up talk, but most of those people are doing just this, talking. When you actually look at the charts, I think there's plenty of room to the upside when you actually break it down. So that's what we're going to do today. Break down the charts, share a couple setups that I like, and kind of show you guys why I think a year-end rally is perfectly within the cards. So starting here with technology, and looking at individual sectors, breaking it down by individual sectors, looking at the RSI, percent from a 20-day simple moving average, and percent from a 200-day moving average. So when we think about breadth being extended, RSI being above 70 would signal overbought to a degree, right? Percent above a 20 being above 5% would probably be a little bit extended. And then maybe simple moving average above 15%, we'll say a little bit extended, right? Because that moving average is kind of a slower train, right? Kind of follows price. So if it quickly shoots up, it's going to become extended from that moving average, right? It's going to create distance between it. And that distance can kind of signal some of the momentum. So an extension. So if we look here, technology is the only one that's even above 60. Healthcare is at 56. Energy is at 51. And there's plenty that are below 50. And 50 is kind of that break line of maybe bullish versus bearish momentum. And so half the sectors in the S&P 500 don't even have overly bullish momentum at the moment, right? Only one sector has a simple moving average above 2%. And if you look at above a 200-day percent-wise, only one is above 10%. So when people are talking about melt up and bubble talk, they're really talking about one sector of the market, which is cherry picking, which that's what people do, right? Most people are trying to write a narrative, write a story, and then they go, I want to write about this. Let me find something to support that. And it's very easy to find individual charts that support your narrative. But when you actually peel back the curtain and look at the data, it's not supportive of that narrative. And to me, this is actually going to be bullish, and we'll get into that in a sec. So with this concern about concentration risk or it just being technology, you're hearing a lot of bearish risk associated with that. The problem is it's like same thing in poker, right? You don't think about risk only to the downside. You have to think about risk to the upside. When you have a hand of cards, you got to think, okay, how can this play out in my favor? How can this not play out in my favor? And what are the odds of each? So when you look at the S&P 500 and you understand concentration risk, it's not just what can happen if these go down, it's what can happen if these go up. So we can look here, the S&P 500, the top 10 stocks make up almost 40%. The top 20 stocks make up roughly 50%. The top 50 about 60%, and then the top 100 make up 75%. So the bottom 400 make up 25%. So that is concentration risk, but that risk can also be to the upside. So what you're seeing now in the media is these statisticians using this data to be bearish. The first time in history we've had 3/4 of stocks down and the market finish up. All of that is a derivative of one thing, concentration. So it's not the uniqueness of what happened with price action. It's just the reality of the market concentration. So what do you do then? If you understand these are that important, plot these on a chart. Plot them on a chart. You have TOPT, ETF that represents the top 20. XLG represents the top 50. OEF, top 100. These are in strong uptrends. So here we go. We know there's concentration risk. We know that concentration risk is in a strong uptrend. So why are we then labeling that concentration risk as a downside risk? The risk of this concentration is to the upside. And it's what you see every year. If you're old enough to remember earlier this year, if you weren't born yesterday, A lot of people were talking about equal weight, this being the year of equal weight. Equal weight's gotten clobbered compared to mega cap tech, compared to the mega cap market movers. And that's just a feature. So the risk to them, to the downside, was overstated. So just be aware of how this concentration is not only a risk to the downside, but also a risk to the upside. Because I just think that theme gets missed way too much in markets. There's too much fear out there because if you sell fear, right, what you're trying to do is create confusion within the people you're selling it to, because then you create the clarity. So if there's no fear in the market, you have nothing to sell. So what do you have to do? You have to get really creative to create confusion to sell something to people. And that's what most people tend to do. Once again, MAGs, 7 stocks make up 33% of the S&P 500. This looks like a pretty strong uptrend to me. Base breakout, base breakout. We're in one of those breakout stages right now. What is the story this week? Breadth is weak. Who cares? Who cares about the backup quarterback for Patrick Mahomes? Does anyone know the backup quarterback for Josh Allen? Do you? Anyone in the chat? Does anyone know who the backup quarterback for Josh Allen is? No. Why? Because it doesn't matter when he's on the field. I'll worry about the backups when Josh Allen's not on the field, but for now he is. You think the Chiefs play the Bills this weekend and they're worried about the backup? No. Why? Because Josh Allen's going to be on the field, right? So same thing here in the market. The Patrick Mahomes, the MVPs of the league are on the field. So the risk of concentration continues to remain to the upside. And with that, let's talk about the weak breadth. I agree. Short-term breadth is a little weak, right? There's not a lot of momentum outside of tech in the market. But within the context of seasonality, right? We're heading into November, December, year-end chase to a degree. And the typical flow of leadership starting with tech and beta, this to me is bullish. It tells me there's plenty of meat on the bone for the market. One of the charts that's symbolizing that is IWM, Russell 2000, right? This represents small caps, right? You see a huge base breakout. So yes, if you anchor to the April low, you can say, look how fast it's ran so quickly. Sure, right? If you want to anchor to the April low, but if you zoom out and look at the price structure, this thing has gone sideways for 3 years of nothingness. And what's the Fed doing right now? The Fed's cutting rates, and this is in an uptrend. So rule number 1 is don't fight trend. Rule number 2 is don't fight the Fed. So why are you going to fight both of them? Because you don't understand concentration risk. It just doesn't make sense. So to me, if anything, it's a blessing to have some of this stuff pull back. And then if we do correct here and we see a failed breakout, we'll start to be concerned. But for now, the breakout that's just going to consolidate sideways. So just be aware of the context of 1 week of bad breath. Once again, S&P equal weight, breakout, and now we're consolidating sideways. So if this is a bull market, which it is, and we do think there's going to be a year-end rally, these are the levels at which you probably want to hold your nose and buy. Wait for some follow through here because breadth is probably going to improve, right? Why do I think that? Well, let's do some breadth analysis, looking at the S&P 500 with percent above a 20-day moving average in the bottom panel. So what you see here is I'm trying to combine a few different things. I'm trying to combine price action, trend, and then breadth. So if the S&P 500 is above its 50-day, that's just a simple way to define trend. So uptrend above its 50-day. You can even use the slope, so sloping upward trend. So we have an upward sloping 50-day. Okay, it's above trend. So I want to buy dips in breadth in this uptrend. Okay, so if we do that, you can see in this bottom panel, I highlight where breadth gets below 40 and starts to bottom out. And you can see those have been good buy signals because that's essentially as far down as breadth can go. And that gives you a chance to kind of get in from a breadth perspective. So you might not necessarily be buying the S&P 500 here, but you want to be buying the market of stocks. So you want to look for stocks that are maybe at the bottom end of their range that have potential to break out. Another reason you want to do that is because then you have really well-defined risk. So you couple those couple things together, tech leadership is not bearish, breadth pulling back to levels of support is not necessarily bearish. And the narrative of there being a bubble, right? Couple all that together, I think we see some opportunity in the market. So where may that opportunity come from? One area I've talked about a lot is utilities. You can go back and watch one of my videos. I think it's called Making Money Outside of Tech. And I pointed out utilities from a technical basis, right? That's how you execute it. And then you build conviction, I believe, via fundamentals, right? Via market regime analysis is where I kind of build conviction. And utilities is one of the best fundamental stories in the market. It's had some of the best margin improvement, best earning improvement over the past year and a half due to some of the AI story, and you've seen it be one of the best performing sectors. So we have a strong uptrend that is kind of pulling back here outside of tech. And so I think if we kind of test this 50-day here, I think names within utilities, I'm not going to go through some individual names today, that'll be your guys' homework, but names within utilities, you'll probably want to buy this dip because you have a strong uptrend with structural fundamental support, right? Kind of confirming, right? So what we want to do here, the nuance of this is you want to buy strength after the dip. So I'm not going to buy on a red day. You see back here, maybe buy on a follow through day. So I would look for some follow through here, but this is one of the areas that's going to be on my list to watch is utilities as a whole. Next area of the market I like is pharmaceuticals, right? So this is a component of healthcare as a whole. And I think healthcare as a whole has really gotten crushed this year. One of the reasons being United Healthcare, and two of the other reason being some of the insurance stuff. I went through my insurance today for 2026 and it's a mess, right? So you look at pharmaceuticals and you have this nice base breakout. You had that retest and you can see another little cup or base forming here and we're starting to break out again. You also see the relative outperformance versus the average stock. So I use RSP here because we know of the market concentration. Sometimes you're not looking at a chart to make a trade, you're looking at a chart to get information. And so I can see compared to the average stock, it's making new highs and price is making new highs. So I have confirmation that if I want to be more diversified, this is an area I can do it outside of tech because we know tech has that ultimate leadership. And some people don't want to be fully exposed to only technology. So this is a chart, I think, within pharmaceuticals, right? I think this looks great above 75. You can even use a 72.50 as a stop. So pharmaceuticals, another area in the market that I look, and I think you can have some buying opportunities in. Another area of the market, financials. I think financials and industrials together, those are like my economic areas of the market. One of the things I'll note about financials is when they reported earnings, a lot of them beat earnings and they also showed margin improvement and forecasted margin improvement going into next year. Part of that is going to be collecting more on net interest margin. But another feature of that's going to be is some of the growth that's going to happen, right? They're going to be able to experience some growth and some efficiencies from either AI or what have you, right? The why doesn't necessarily matter when it comes to the margin expansion, as long as it's being supported by earnings growth. And so right here, you see financials. If we're in a bull market, like I said, and we've seen tech lead, the next step is seeing rotation into other areas of the market. It has to happen in order for the bull market to continue, in my opinion. So what you see here is you're at the bottom of the range at support. So like this is an area where you can step in and you have really well-defined risk against 50 for financials, right? There's some names within that I'm going to get to, but overall financials is an area that this failed topping pattern is a common thing you see before continuation, right? So you could draw this here and kind of draw, a semicircle. But what happens is these tend to fail, and then you see that upside follow through. I'd also note here we never got oversold, which is great to see. So it's really just been exhaustive sideways price action in something like financial. So I'm looking for financials to follow through. Also, consumer discretionary, right? Had a similar cup and handle build here, had that failed breakdown in because of Amazon got back above this level. So you have really well-defined levels that if you believe a year-end rally is to come, or you believe the bull market is going to continue, the next step is breadth expansion. So other areas of the market outside of tech that have yet to take off are probably where you want to place your money. Could that not be the case? Sure. Could it just continue to be tech? Sure. but you have really well-defined risk in a lot of these names to take that bet. And so some of the areas you could take the bet, right? Bank of America within financials, beautiful base on base breakout. You had confirmation here today. I love the look of Bank of America as a whole. I think that's a beautiful looking chart. I think banks in general, you have Citigroup also looks good. Wells Fargo looks good. Morgan Stanley looks good. So those are some areas within financials that I think could be favorable. And then software, right? I was talking about tech being extended, but there's areas within tech that aren't extended. Look at software. Software is kind of just trading in this range. And so you have well-defined range here where if we get this breakout, right, software could be back off to the races. And that's a large component of the S&P 500. So if semis took a break, because semis are kind of the leadership right now, if semis took a break and software breaks out, you could see internally something like NVIDIA take a breather and Microsoft take off, because NVIDIA is in the semis and then Microsoft is in software. Names like Salesforce look like they might be bottoming. MongoDB looks okay. Cloudflare looks okay. A lot of those cybersecurity names look like they might be ready to break out. So all in all, you get into these intra-sector, intra-industries within tech, you have some areas that might be ripe for opportunity, and software might be one of them. And so with that, guys, those are the charts I wanted to rip through this week. I know it's Halloween. I know it's a Friday, so I just think my main takeaway for you guys here is that, yes, it's only tech that's extended. There's other areas of the market where opportunities are going to arise, and that's where money is most likely then going to shift into. And then if it doesn't, that's information for us, right? Because you expect these next legs of the bull market to kind of move in that direction. So if this doesn't happen, that'll be information for us. But overall, I think you can kind of start to expand your horizon. If we see kind of breadth start to bottom, you saw Ron DeSantis talk about breadth this week in the market. You're seeing a lot of Mag 7, Mag 7, Mag 7 type narratives. And another reason people want to create those narratives is think about end of the year, all these financial advisors and money managers. The more they can push that narrative to your parents and our parents and people who have money being managed, the more excuse they already have built at year end when Sally comes in and says, hey, why did you underperform the S&P 500? Oh, Sally, let me tell you, have you seen the news lately? Yeah, actually I did. Did you see that article written about how it's only Mag 7? Yeah, I did. Yeah, well, we like to protect your assets, and so we've been more diversified away from that. That's why we underperformed. So all of that is a ruse in the market to already prepare people for underperforming for the year. So that's my take, guys. It's a bull market. You have to continue to look opportunistic. If we see downside follow through in any of these areas, we'll be highlighting it next week. But until then, stay safe, eat some candy. Cheers.